Hello and welcome back to the Vancouver Life Real Estate Podcast and YouTube channel. Today we are very excited to have a special guest with us. Kyle Green from the mortgage team is in the house. And Kyle, just off the top here, a couple things about him and his history. He runs that mortgage team currently with 10 staff brokers involved there. And Kyle's been working as a mortgage broker since 2006. So about when he was 12 years old by the look of him.
19.
19, incredible. Knew what he wanted at 19. That's a rare breed indeed. But he has really carved out a niche within the mortgage space as he focuses almost primarily on investors and investment properties. His years of experience working with the Real Estate Action Group and many other investors and investment groups has made him essentially one of the go-to resources for financing investment properties in Canada. When you want to talk numbers, his career has over 4,000 mortgages funded, equaling over $1 billion in financing. So very impressive and clearly knows what he's talking about and has probably seen and done every style of mortgage there is out there. So a wealth of knowledge on today's episode. We're really excited to dig in. He's also a published, writer here. His articles have been featured in many publications, including the Vancouver Sun, The Province, Western Investor, and more. When it comes to creativity, well, one of Kyle's proudest awards has to be the REAG Joint Venture Award for Deal of the Year, where he closed on a $1.15 million property with $0 of his own money. I'm sure we'd like to hear more about that as well. Kyle has been investing in real estate personally, and his cash flow analysis spreadsheet, which he originally designed for himself, has been a huge hit with thousands of investors currently using it. And we will be giving that away today as well for anybody who wants to figure out if the property that they're analyzing will actually cash flow. So his creativity goes a long way in finding ways of getting tough deals approved. Whether you are a first-time home buyer or an investor or anywhere in between, Kyle has the skill set to help you grow your real estate wealth. Kyle, welcome. We're so happy to have you today.
Yeah, happy to be here.
So as a mortgage specialist whose clientele is primarily investors, what percentage right off the top do you think that would be?
Probably about 70%.
70%?
Yeah.
Okay. So definitely, like you said, you've carved out that niche. Yeah. So you've got tremendous insight into where and what type of properties people are buying. And we get this question all the time from investors. Where should I go? What should I buy? Can you share with us, with all the data that you've been receiving over these years, where are you seeing most of the demand in the marketplace now?
Yeah, it definitely varies, and it depends on where interest rates are. It depends on the cycles and trends. But I think if you're looking for cash flow and you're looking in British Columbia, then certain areas like Kamloops, Prince George in particular is an interesting market. One of the things we often look at is the rent to price ratio, so the amount of income that you can generate monthly versus the value of the asset. And anytime you can get over about 0.4%. So that means that if the property is worth $500,000, you're ideally trying to find something that generates $2,000 or more in monthly rental income. Back when interest rates weren't extremely high, that actually used to cash flow. Now, not so much. It's a bit harder, right? So you're finding that people that are trying to find cash flow, the number of markets you can find that in is starting to shrink. Yeah. Personally, I really like downtown Vancouver. The cash flow is not as good, but the valuations, and you guys know more about this than I do, but the valuations haven't really changed a whole lot in like 5, even 6 years. Yep. And I think that a lot of people moved away from the downtown core because of COVID. Yep, and some people are starting to come back, and people want to be closer to entertainment. Some people's employers are wanting them to be closer to work again. Mm-hmm. And so I think that people will start to come back into that market over time. So I do like downtown as well, but I think it'll take some time, and it's not as much of a cash flow play.
Yeah, and that kind of brings me to our next question. I mean, you built this sheet, and I was going to jokingly say, like, does it work anymore?
No.
Yeah, right. But even with rents at all-time highs, they haven't really kept up the same pace of real estate prices in Vancouver. Mm-hmm. And for the most part, this makes investors cash flow negative buying a downtown condo when you consider an 80% loan-to-value scenario. So does appreciation make this type of asset still viable? Is that the play there? Or is Vancouver just overall, in that scenario, 80% loan to value, is that becoming just too expensive to invest in from that perspective?
Yeah, it just depends on the situation of the borrower now. The reality is that the appreciation perspective has a very large impact on the overall return on investment. So If you put 20% down, that means for every 1% of appreciation, your return on investment is 5%. So let's say that you bought a $500,000 condo and you put $100,000 down, so 20% down. If the value of the condo goes up by, let's say, 10%, so it goes from 500 to 550, you've made $50,000 not on a $500,000 investment, but a $100,000 investment. That was your down payment, right?
Yeah.
So you've actually made 50% return on your capital, not
cash
a 10%
on cash return. Yeah.
Right? Exactly. So the reality is that just having the appreciation needle move 1% this direction or that direction actually makes a really big impact on the bottom line.
So a little follow-up question then, I guess, in terms of when an investor is looking at this play, are they prepared oftentimes to float that property based on the appreciation?
Now, yeah. I mean, that's why you would make that decision, I think, in today's market. I think that's a tough one. And so when you look at the overall return on investment and try to map that out, I think you'll find, and in general, I usually recommend investors do this. If you're looking at a market that has more cash flow, in general, they usually tend to have less appreciation over
Very
time,
much so,
right?
yeah.
And so you look at it and you say, oh, it generates more cash flow. Okay, great. But what is the expected annual appreciation? And just knocking down the expected appreciation by 1%, the cash flow would have to be significantly higher for it to balance that out.
Significant being the optimal word there.
Yes. Yeah.
Fair
exactly.
enough. Yeah.
Got it. So with prices in most of British Columbia being as high as they are against the rent ratio, if you will, we've seen a lot of people, of course, look across the border to places like Alberta. Do you work with people who invest in that area, and do you advise that they do invest there?
Yeah, we actually have seen a fairly large uptick. A lot of investors are looking in Alberta. I'd say that, obviously Calgary and Edmonton. Calgary, to a larger extent, seems to be a really hot market right now. The thing about Calgary is a little bit harder to cash flow real estate there. Part of the reason is a lot of Calgary is in a floodplain, and so there's less basement suites. And as a general rule of thumb, if you have the same square footage and you have two different homes side by side, if one of them has a basement suite in it and the other one does not, then usually the one that's suited, even though it's the same square footage, will usually generate more rental income. You can usually get more rents if you just chop it up. In Edmonton, it's a little bit easier to chop them up.
Yes.
Yeah. So you'll find I like the duplexes and fourplexes, those style properties in Edmonton in particular. And then Calgary, it's a bit more of the detached with a basement suite, or maybe the condo in the downtown core, the two kind of assets that can make sense. But the cash flow is not quite as good in general. It's more of an appreciation play there.
Got it.
Yeah.
Fair enough. So considering the government and all of their legislative changes over the last couple of years, they're making it appears like it's investors against the government.
Yeah.
It's really how it feels. And it's becoming far more challenging for investors. With, increase in down payment requirements, the stress test, increased taxes, and most recently restrictive bylaws on Airbnb units, which I'm sure was a big factor in your spreadsheets, and a big factor for a lot of investors as to why they would even buy that unit to begin with.
Oh yeah.
But how are you seeing these changes now, I guess, impact the actual investment choices? And are there opportunities being created in this environment as well? Like, every door shuts, another one opens kind of thing? Or is this really just hampering down on investors?
Yeah, the opportunity, the door that's opened up a lot, GICs look pretty good all of a sudden. 5%, baby, sign me up. I don't have to do a thing. All right. And to be very frank, a lot of my investor clients literally did exactly that. So I think the opportunity in a high interest rate environment is not to borrow money, but to be lending it out effectively. And by buying a GIC, you're lending the bank money. Private lending, for example, is something where we've seen that the rate of return for private lending is increased. So we have a higher demand for private lending because it's harder to qualify, and a higher supply because more people are looking for yield in this market. They didn't want to buy the real estate. So you can lend out your money and earn a 12% return on your capital. And that's not bad, especially if you're not sure if you want to own the real estate. And in general, I think that overall, over a long period of time, from appreciation, having the tenant pay down your mortgage for you, and eventually cash flow, I still think the overall return on investment from investing in real estate between all three of those will still be generally higher than that, 15 to 20% over a long period of time. But short term, a lot of investors just tapped the brakes on buying and instead became private lenders.
Interesting.
Yeah.
Wow. So, okay.
Largely about being creative.
Yeah.
Essentially, right?
Well,
and not
short
putting all
term.
your money, yes.
Short
absolutely.
term, right? And
Yeah.
I have seen very recently, you guys have probably seen this too, a major uptick in the number of inquiries just in the last 3 weeks.
Oh, huge.
It's crazy.
Yeah.
And so I think our investors are ready to jump in again now because
Yeah.
they're thinking, okay, I think an investor is generally more willing to be early than too late to a market. And right now it's in that early stages where I think they're worried that if they don't buy in the next 3 months, then prices are going to start ramping up as soon as the Bank of Canada makes one prime rate decrease, and they're going to be jumping over 10 other people to buy home. And so I think a lot of people are starting to get back into it, and they're just making that judgment call to say, might be cash flow negative.
There's definitely a lot of people in the last little while who have just been in this wait and holding pattern just to see what takes place.
Oh, yeah, totally.
And I feel like, there's only so long we can have restricted credit until the economy really falters.
Yeah.
And then we're in, we're taking the elevator to the basement.
And then that's when rates go down.
That's right.
Right. And then what happens when that happens? Values generally go up,
That's it. And I think, too, the average consumer is a lot more educated than they used to be, even 5-10 years ago. And so when prospective home buyers or prospective investors have seen cycles before, and they know what happens when rates drop or when there's pent-up demand, etc., maybe they don't want to fight against 4 other people for the same property. They can get it under contract in a more civilized environment.
Yeah. Oh, yeah. 100%.
Got it. Okay.
Yeah.
So again, talking mortgages here, for investors that are looking to build a big portfolio, big being, let's call it 5, 10, 15 properties, talk to us about how to navigate that and how many mortgages you can actually obtain as an investor, because there are caps with certain banks, if I'm not mistaken.
There are, yeah. So in theory, if you made $1 million a year, then, well, even that might not be enough. It depends on what you're buying. Yeah, exactly, right? But the lenders usually have caps or limits. The common cap or limit is about 5 properties. And for some lenders, that's in total. Some lenders, that's 5 with them. But the majority of lenders, especially the non-bank lenders, we call them, so lenders only accessible through mortgage brokers, a lot of them are about 5 properties max. Okay. Then a lot of the banks will go to 5 or maybe up to 10 in total, as long as no more than 5 are with them. And every bank's slightly different. One bank will be 9, one bank will be 7 or whatever, but they're all in that kind of range where you usually can go properties number 6 to 10 with some banks. It gets really tough when you have over 10. Just to paint a picture for you, I have a client that makes $1.5 million net income per year. His business makes even more than that. He's got 13 rental properties in his portfolio, and only one bank would finance his most recent condo, and they'd only give him 30% financing on it. So it was 70% down payment.
What's the point?
If he can't get a mortgage, then what do it's tough.
It kind of brings up an interesting question and follow-up question to that. So if someone's looking to get a big portfolio, then instead of doing 13, call it doors, would you be like, hey, listen, we've got to have a look at some multifamily here and get 4 doors under one title kind of thing, or more under one 100%. Title, if that's how the bank is going to see it.
Yeah, and that's another reason. Even as an example, I've had a client that said, hey, I'm looking at buying in Edmonton and I'm looking at condos. It's like, well, why don't you just buy 4 condos all underneath one title and buy a 4-plex? It's the same cost, you're going to get the same rents, etc., but it's one property in the portfolio instead of 4 condos, and now you're almost tapped out with a bunch of lenders, right? So I agree with that. And to take things further, I know you're asking about what are the opportunities in this type of climate, and I'm noticing a really big shift, not just on the private lending, but also in the multifamily space. So in CMHC insured multifamily financing, so that's 5 or more units. CMHC in certain cases can give you up to a 50-year amortization. The rates are lower than residential interest rates, and you can get up to 95% financing, which is very, very difficult to do in British Columbia, by the way. But if you fit the box, you can get way better terms, actually. And I think that's one of the things that you're going to see a lot of government pushing is to have people build more purpose-built rental properties again. It's been a long time since we've had that.
When you say fit the box, are you talking about the way that the bank will see you, or is there a particular set of things you can do to fit the box? Yeah,
so the way that the CMHC multifamily program works is in order to get a 50-year amortization, in order to get those high loan to values, you have to hit points in energy efficiency, affordability, and accessibility.
I see.
So there's all these different terms, and without going into a ton of detail, you can hit different point levels with different categories.
And they'll fund you accordingly.
Exactly, yeah. And then the other factor too is then you have to look at it and say, well, how much is it going to cost me to hit the points by going the energy efficiency route? Because you can actually hit the points by just be very, very energy efficient. And in BC, the energy efficiency requirements usually require you to hit a certain number of points anyways, just based on the BC regulations and requirements. So yeah, it's just a matter of then trying to map it out and look at the feasibility of the project. But I will say, I think what we're going to see is a lot of mom-and-pop investors that want to have 5 or 10 properties themselves. I think they're going to team up with a few other people instead and say, well, let's just have 4 of us buy a 20-unit apartment building instead of each of us going out and buying 5 units each.
Makes a lot of sense. And maybe from a top level, can you share how the qualifications change from going personal, maybe buying a door or two, to a multifamily 20-door style property? Yeah,
so what you'll find is anytime you're dealing with commercial lending, so that's 5+ residential units or basically everything else. So 4 and less residential units is residential, and everything else is going to fall under commercial. So a warehouse or a strip mall, retail space, anything like that. So what they're looking for is something called a debt coverage ratio, and it's a DCR. And so they want to see that the income is about 1.2 to 1.25 times all of the expenses. So they reverse engineer it. So let's say you're finding you found a property that generates $12,500 a month in income, and let's say that the non-mortgage expenses are all $4,000 a month. Then they would lend to an amount where the mortgage payments don't exceed $6,000 a month, because the total expenses would be $10,000 on $12,500. So that's 1.25 to 1 for income to debt.
Interesting.
Yeah.
We're on a different. Seeing as we're kind of talking about rates and how to qualify here, I'd love to kind of see what you think is going to take place here in 2024. It's
the crystal ball. Hey, I stopped working a little while ago, but yeah.
Yeah, well, so did ours. So listen, when we saw the Bank of Canada raise rates, they actually moved out of lockstep with the U.S. Central Bank, and that's uncommon. Yeah. I think in many ways, especially when you consider how tightly closed our economies are. Do you think that we're going to start to see the Bank of Canada cut before the U.S., or do you think the U.S. is going to lead that charge?
Yeah, I mean, we are very closely tied, but there's a lot of concerns that Canada's economy is in worse shape than the US's is.
Oh, I believe that.
Yeah.
I believe that.
Yeah, and so
their ability to take on debt is way higher than ours.
Big time. Yeah. It's way cheaper for them to take on debt, so there's a lot of factors there. But I think, and just very recently, we saw the bond market, which impacts fixed rate pricing. Bond markets are basically forward-looking markets that kind of predict where rates are going to head. And so now, the last couple of weeks, all of a sudden, it looks like the U.S. is still very strong. Job numbers are really strong. Inflationary pressures. There's so many different nuances here that are affecting things, and so it does seem like Canada is weaker, and they may start the plunge a little bit earlier than the U.S.
It kind of echoes David Rosenberg's position. I don't know if you follow him, the economist, and he recently released an article where he talked about Canada's economic position being in a lot worse shape than what's being reported.
Yeah.
And generally speaking, rates as to when they exactly fall is kind of anyone's guess, but generally speaking, they are likely to fall sharper than people are anticipating because things are worse off than they appear. Would you agree with that?
I would say so. Yeah. And I think that one of the things to look at too is in 2015, Canada moved downwards. I think it was 0.5 or 0.75%, and the U.S. did not move. And one of the reasons for that was that oil was taking a complete nosedive. Now, one of the things that we also have to look at is commodity pricing and then the dollar as well. So notice the Canadian dollar has actually been creeping up. It's 72 cents or so, which is a little bit higher.
Not good for us.
It's not actually. People, I remember back in 2008, 2009.
Parody.
Yeah, exactly. Everybody's like, yeah. I was at a rock concert and the singer was like, "Hey, congrats on being at par." And, it's really like
we're an exporting country. That's
exactly right. So one of the factors is that when you drop interest rates in Canada and the U.S. does not, it pushes our dollar down and it basically puts our stuff on sale, which is really important if you're a net exporter of commodities, right? So if I think we have to watch what happens with oil prices, etc. But especially if oil pricing is also down or isn't going up, then I think that it wouldn't be unheard of for Canada to drop and put our stuff on sale.
So overall, obviously, the economy has been in a downward trend for most of the last, let's call it 18 months or so. And that affects sentiment. And there's a reason why we saw residential sales drop quite a bit from the last couple of years. But as we also know, a lot of investors will look against the grain, if you will. And so while sentiment might be low, it has started to creep up. What are you feeling, or what are you seeing in the investment side? Are you seeing an uptick? Has it been an uptick for a while? Or what's sort of the average investor feeling right now?
Yeah, the uptick, to be very honest, is like a 3-week, 4-week phenomenon.
Okay.
During the holidays, between Christmas and New Year's is when it started, and then it carried right through in early January. Traditionally, and I hate saying this cycle stuff because honestly, since COVID, the normal cycle has not existed, right?
Yeah.
Some of the January months have been my busiest months, and this January is no different. But normally during the holidays, between those 2 dates and then the first week of January, usually it's quite quiet, and it was very busy. And a lot of it was due to investors wanting to get prepared. They've been sitting on the sidelines for so long, and like, okay, I think that this might be the last opportunity in the next 3 to 6 months to not be competing with a ton of other people in a place. And sure, maybe interest rates will drop further and I'll be a little too early instead of too late to the party, but I think that they're getting ready. And so the majority of the activity is more the investor clients. We are getting the homeowner clients coming in as well, but I generally find that they're more likely to wait until the very first actual sign, right? The first time the Bank of Canada drops 0.25%, boom, they all flood in, right?
Yeah.
But I think that the investors
there's a
are,
herd mentality to that.
totally, yeah. And I think the investors are going to say, let's start to do this now, knowing that it's going to come soon. So
I've got an interesting question. It kind of came to me as you were saying that. A lot of times when we speak to investors and we speak to end users, I think there's this misconception, at least it feels like it to me when I speak to investors, that investors don't make emotional decisions, that it's just it's just all business, right? And speaking to sentiment, that's one thing. But I personally think that investors at times are even more emotional than the end user, outside of maybe your forever home.
Yeah.
And would you corroborate that? Like, do you feel that investors they make emotional decisions, or are they purely calculated, and is this just all about returns and profits?
I mean, a lot of the clients that I work with, I'm a numbers person, and you generally tend to attract people that are similar to you or aligned best with them. So a lot of my clients are fairly numbers driven when they're making decisions. But I do think what I've been finding is that the news flip-flops back and forth. Inflation, oh, never mind, rates are going to go down, rates are going to go up. And I think that emotion, so the logical emotion, if you want to call it that, rational emotion is flip-flopping. And I'll have clients that are ready to go 1 minute, and then you follow up, and then I'm going to pause for now. And so
that's kind of what I'm getting at. It seems like you're supposed to be the one who sees this. Yeah. Why is this difficult for you right now?
Yeah.
Right.
Yeah.
And I just found it interesting. So
the whole buy when others are fearful thing. Historically, investors have always been a counter lever to normal market circumstances for me, and they haven't actually been. It's been like my investors have overall been very quiet for the last 2 years, and they're starting now to get active again. But the
psychology of buying low takes a lot of practice.
And it's funny because it's not even buying low, it's buying like mid. The values didn't go down, they just kind of stayed flat. So it's like buying before the next boom, I guess. It's tough.
Interesting. What if too, there is a lot of talk of rate cuts, and there's a lot of people, quote unquote, waiting. What if things change? What if we see a year with 0 rate cuts? Which, after last week's inflation, maybe that's a potential outcome here.
Yeah, higher for longer.
Sure. Yeah. Is that,
always.
With Vancouver and the way that we see people buy, yes, it can be a pause in the marketplace, but pent-up demand really is a thing here. And we see it cycle after cycle.
Yes. Yeah.
Let's say we're at 5% overnight rate for another 12 months. Like, do you see residential buyers coming back for homes? And do you see investors doing stuff in that environment as well?
Yeah, I mean, even if rates don't go down, we're still going to see activity. And I think that this year's activity will be better than last year's activity, in my opinion. I guess this is not a great analogy, but if I have this cup and every month I'm pouring more water in it, there's more buyers. But this, everything else is staying the same. I think that, rates decreasing and other things will make that cup shorter and could have the spillover happen a lot faster. A lot more water will fall out of it. But if I just keep filling this cup, there's a certain amount of this will keep spinning out. In fact, even if the cup got taller, i.e. rates kept going up, it depends on the speed at which rates are going up versus the speed at which I'm pouring water into the glass,
Yeah.
And immigration, and there's just so many people moving here, and there's also just reasons that people want to or need to move. But I would be surprised if rates go up. I wouldn't be that surprised if they don't go down as much as people are predicting. Some of the predictions have been starting to get pretty heavy-handed. It's like that's pretty aggressive, and it's by people that professionally bet on this too. Like they're putting their money where their mouth is, and they're saying it's not just the economists thinking this. It's like people that professionally bet on this, that are banking on 1.25 to 1.5 decreases during 2024, which I think is way too much in my opinion.
But you think it's going to be more like 0.5% or 0.75 kind of thing?
If I was betting on it, I'd probably say 1, maybe 0.75, but I would probably say it'd be more likely to be 1. But the problem is on a per week basis, like as of right now, maybe I'm leaning towards 0.75%, but a week or two ago I was leaning towards 1.
So it changes every week.
It does, right? So that's the issue. It's just like it keeps kind of moving a little bit, but it's not, my opinion is not as swingy as what you see in the news and whatnot. It's going to be somewhere in that range, and I think 1.25 is probably aggressive.
Okay.
I think too, what we will find is, let's say you are a potential home buyer and you've been looking at the market for, let's say, I don't know, a year now, right? Where overnight rates was between, let's say, 4.5 and 5. Well, if another year goes and it's still at 5, they're like, well, that's just the market in a sense, right? Because that's their snapshot. And so they'll be like, okay, well, I'm still going to buy. I'm going to buy what I can afford because this is what the world is right now. Because so many people will not know what was like 3 years ago.
I know.
As time goes on. But
well, there's pressures out. There's also pressures outside of just rates to buy a home. Investors aside, if you have a kid, you need more space. There's lots of reasons why people will need to buy. And if 5% is the new rate, I think what's irked people the most about the last 20 months has been the volatility and the uncertainty of things.
Yeah, exactly.
And especially investors. Investors, they like pull back hard when you see volatility and they can't predict where things are going. I think as we stabilize, ideally, in over 2024 and over 2025, and we find out where the new rates are going to be, I think you're going to see, like we've talked about, a decent return to the marketplace. What's also going to be really interesting too, and I think this is maybe an interesting segue, is the Multiplex plan, which is a significant sort of legislative change in terms of densification throughout the entire province, initially started by the city of Vancouver, and then in many ways usurped by the province. I'm wondering, while the cost of construction financing and the hard costs, is expected to remain high, especially in the core of Vancouver, we could see the density element, as in terms of 6 rental units on one lot, go to 8. We'll see. It's unknown. There's a lot of unknowns right now. Do you think that's something that's going to be really attractive to investors? Do you think they're going to see, again, this is an opportunity where you could buy 1 unit and hold effectively 6 renters inside of it? So are we going to see that predominantly be an investor's choice now? Is that what they're going to be looking for, single family lots to try and take advantage of this plan? Or do you think costs are going to remain so high and maybe permitting is going to take so long that it will stifle that economic activity and the housing that we so desperately need too?
Yeah. So I have had some investors bring that and say, you know what, our plan's changing. We're not going to buy condo. We're actually thinking of buying a detached for 2.5 million, and this is our plan. So yes, I'm starting to see a little bit of a trend in that direction. I think the problem for a lot of investors is if it's not your residence and you're borrowing $2.5 million, because it's a lot, and it's really hard to cash flow that. And even if you know that the prospective gains in the future will be high, I think you're going to see builders make those plays, and you're going to see those types of investors and maybe more
vertically
institutional. Yeah, exactly. but I think that the mon pa investor is going to struggle with it. But it might just be, and yet another thing that kind of pushes people back to detached for like their own primary residence, because a residence is still an investment, right?
Absolutely.
So
yeah.
I think you might see people saying, let's just stretch ourselves a bit more, buy something with 2 suites in it for now, something that can be developed into 6 to 8 in the future, and this will be our retirement fund.
Interesting. It's kind of like the multiplex plan is going to be maybe so difficult for so many people to actually do that you're going to see a push towards the other asset classes.
Yeah, I think it'd be tough, right? And I think the issue is just servicing that much debt. Like in general, an investor usually tries to borrow the down payment from their home equity line of credit, so you can write off the interest portion of the payments there, and then buy the asset. And when you borrow down payment plus the purchase price, or plus the mortgage on the new purchase price, you're borrowing all of it, and $2.5 million bucks.
It's a lot.
Big payment.
Well, I mean, rents have gone up considerably in Vancouver, and I think it's hard to know where they're going to go from here. If they'll continue on that pace. I mean, we saw a tremendous rise in rates over the last 2 years, and maybe that'll bring back the investment to some degree. But I still think the price of real estate here far exceeds the serviceable rent that you can pull from it. So there's probably a limit to this in terms of opportunity.
Yep, definitely.
Do you think then, are there other areas in the province, as it is provincial wide, that maybe somebody who's sitting on their $600K, mortgage-free property, that's like, okay, cool, I can sell it today and I'll net, let's say $550,000. But maybe I invest and I build 6 units on this thing and I sell it. Well, now I'm actually netting double that or triple that.
Right.
Will this kind of create some almost like accidental landlords, like we saw through COVID, create some accidental developers, if you will, just because the potential and the opportunity is there, right? They got one chance to sell that chunk of land. Do they sell it with 1 home on it or 4 or 6?
Yep. Yeah, I mean, I do have a fair number of clients that are already doing that, and I think we'll see more of that moving forward. Areas and markets that I think you might see more of that. I think Victoria and Vancouver Island in general is a pretty good market, and especially because it's attracting both an older generation that are looking to like retire there,
right.
But it's also attracting this like 30-year-old group of people that are nurses, teachers, etc., where their income actually doesn't change, but their buying power is exactly right by moving over there. So I think there'll be actually a growing segment of individuals moving to the island, and I like that. It's a more of a slow and steady type of investment, but it's bigger than like buying in Prince George or something like that, right? So I think it'd be an interesting area. I think you'll see a lot of that there.
Interesting. When I think about the multiplex plan, I got initially really excited about it because I finally saw a way for us to service the level of density required in the city. Mm-hmm. But when you think about the cumbersome process that's going to take place and so many unknowns at this point, the idea of everyone becoming a civilian developer, I think, is a difficult thing to do, and I'm not sure everybody has the appetite for it. And now, if you're saying, well, I'm not even sure, especially when you look at construction financing right now, which, I mean, it doesn't even pencil out to build a house.
Yeah.
So, that actually kind of leads to another point, which is if builders can't build when inflation rates become high, I mean, the whole point of bringing inflation rates up is to stifle economic activity to allow supply to recover so that when you bring it back down, you found your equilibrium again and you can keep going. Mm-hmm. But if supply never returns, or the future supply of homes is too difficult to build or too cumbersome or too expensive, then the price for real estate is almost set.
Yeah, I know. I think that's the primary issue for sure. And I have some investors wondering, well, should I be buying properties now because of the what you're mentioning? Mm-hmm. This should increase the supply, but I think it's going to be 3 years away before we see minimum. The impact of what's happening right now. And so I still think there's some short-term gains to be had for sure in that. And I guess I worry that the government's not going to get out of its own way. Like they have to figure out a way of giving you, here are the 6 or 12 or however many it is, approved floor plans, totally. the new Vancouver special. Yeah. And you can crank this out on this type of plot in this type of area, and you can just do it. And cut down the time, especially because the problem is in the city of Vancouver, it's at least 12 months to get your permits, etc. Minimum. Borrowing that at 12% interest is really expensive.
Why would you?
Right? Yeah. Exactly.
Like you'd go to a different marketplace.
Yeah.
which is probably what a lot of investors have done.
Exactly, right? So many investors are looking in the U.S. It's just so much faster and easier to invest in the U.S. So,
Well, in many other provinces, they can build a tower in a quarter of the time it takes to build here.
Yeah, exactly.
We just heard of another story yesterday of a development in the West End that's gone down, a 55-story tower. I think, they bought it for $172 million. And right now they're getting offers between 90 and 100 million.
Oh my gosh.
Yeah.
Crazy.
Yeah. After waiting 5 years for the city to basically say no.
Yeah.
Oh,
it came down to
5 years. What was the monthly interest payment on that?
$620,000 interest.
Jeez.
Yeah.
That's insane.
Yeah. And this came down to view cones. And when the story came out, we also heard now that, the city of Vancouver is reviewing its view cone policy. It's like, what's more important?
Yeah.
Fancy buildings or actually providing housing stock?
Yeah, I know.
I know what my answer would be.
Yeah. Exactly.
So let's shift gears a tiny bit here. A lot of our listeners are about to be first-time investors, or maybe they've got their first and they're looking for their second or third.
Yeah.
It's a top level and it's a loaded question, but let's see how we can do here. If somebody or when somebody comes to you and says, look, Kyle, I've got 150 cash or I've got 150K access to line of credit, and I definitely want it in real estate in BC, what do you advise?
Yeah. Yeah, you weren't lying when you said a top level question. Eh?
It's not going to be easy.
Yeah, exactly.
And I want an address.
That's MLS listing R274. Yeah.
Can you make that work?
Yeah, exactly. Right. Yeah. Okay, so there's a couple of things. I think part of our job is to open a few doors, but it's also to close a few doors too. And so sometimes you have to look at what is the financial reality of your situation? What can you actually qualify to do?
Right.
Because in some cases, what makes sense if you could qualify does not actually make sense for you personally, right? So,
or as an investment.
Exactly. Yeah. So I think that there's some nuances there. I think one of the important first steps is always to look into setting up your residence properly, because the residence is usually the hub of your real estate investing.
Right.
And any money that you've borrowed to buy your home is not tax deductible. But if you borrow against your home to invest, then the interest portion of the payments are tax deductible. Get accounting advice. I am not an accountant. But one of the things, and if you had 150 grand cash, what you could in theory do is you could make a prepayment on your mortgage to pay it down and then re-borrow the 150 grand back out on your home. And now you write off the interest on $150,000, which you weren't doing previously. So that's a really cool, very easy, simple trick to do, but it requires you to have the right product in your residence, and you want to make sure that that's set up properly. So that's usually step number one. Step number two is, okay, now what do you qualify for to go out and buy something different? And I think that we usually have to narrow things down. And then once you have a price range and qualifications in mind, then usually try to narrow it down to a couple of different markets and just look at, okay, what seems to be working in those areas and markets. And usually that's where I give them, if they don't already have some tool to analyze the real estate, I'll send them my cash flow spreadsheet to say, start playing with numbers, because you might find property A and B, they're different price points, different rent amounts. I like to just drill things down to one metric, which is a return on investment, because it basically takes everything and it scales it down to the same number. So it's a lot easier to compare property A and property B, right?
I think too, like one of the things that came to my mind when Dan asked that question is also, I think it's fundamental for investors to also have a investment philosophy. Because I think, and maybe you can speak to this, you've written books and stuff like that on it. But, one of the most, I think, incredible things I ever read was when I was trying to figure out what Warren Buffett was buying in the markets. And the best article I ever read that was written by him was, listen, you only need a few good racehorses. That's number one. And number two, you need to have a philosophy. What works for you? What are you trying to achieve? And what are your metrics to say, hey, listen, we're hitting this now. Now it's time to move on. And maybe you can speak a little bit to what a good investment philosophy would work, or how it would work, especially when you're looking at, say, 150 grand or 200 grand. Would you look at, listen, what are we trying to achieve first?
Yeah,
right?
Big time. Yeah, and there's so many moving parts, and that's where it's really hard to say just do this one thing because every person's different. But it's a great point you brought up, which is that some clients are all about the cash flow market, and then they'll buy multiple properties in the same market.
Right.
They'll say, I really understand the Prince George market, and they start doing deal after deal there, and they know where the good areas are and the not good areas. And you sort of get some economies of scale too. You start to go to the property manager and say, I've got 5 properties, 4 units each. I've got 20 units under management with you. Instead of 10%, you think we can negotiate 8? You get one handyman to service all of those properties instead of every time anything comes up, you have to find a handyman in a brand new market, and that's always a pain in the butt.
That's a great point.
So there's some economies of scale of picking one area and working that. So sometimes the strategy and the philosophy can sometimes also just be market related and market driven.
That's a good point.
All these answers, Kyle, are exactly the reason why if you are an investor or you want to be, go and make sure that your team is also a real estate investor.
Totally.
Right? If your mortgage specialist has a portfolio and has done 3,000 or 4,000 deals on investment properties, probably have a good idea of how to help. If your realtor has an investment portfolio, talk to them over, let's say just go into Realtor X who's never even bought an investment. You know what I mean? So your team is so valuable. And obviously it was a loaded question, but you've navigated it exactly how you would any investor who would come up to you, right? It's like, it's not black and white, right? There's no two investors the same. And so creating a customized and tailored plan to that person's needs and maybe uncovering things they didn't even know they could do or access is a huge part of why you want to make sure you're working with a professional. Yeah, exactly. Yep. Why don't you maybe expand a little bit on that then? So if somebody comes and wants to work with you, what do you and your team offer? What would it look like coming to work with the Green Mortgage team? Well, it's awesome. Let's start with that.
Just like ours.
Yeah, exactly, right? The first thing is really, as you guys have kind of mentioned, I think that asking about the game plan, that's something that I find when we ask a client, okay, so what's your game plan? What are you hoping to achieve? Where do you see yourself in 5 or 10 years? It's a question they haven't been asked, even if they've gone to a bank or another mortgage broker that doesn't specialize on that. Yeah. People are definitely very transactional in nature in this business. And so I want to make sure that the first property that we do together or the first transaction we do together is fitting the long-term objective and the long-term goal. Because if I don't ask where you want to be in 5 years, I don't know how to do property number 1. Mm-hmm. Yeah. If you say, I want to buy 10 properties in 2 years, okay, that's very different. How much capital do you have? You need investors. Maybe we should be setting the first one up in a company name, not a personal name, because it's very expensive if you start off and buy 5 properties in a personal name, and then you say, oh, well, now that I know that I wanted to do this, I should have bought them in a company name to start.
Or I should have bought all multifamily because now no one will lend to me.
Yeah, exactly, right? And there's all these nuances. So it's important to look at like where you want to end up, and then you kind of reverse engineer it backwards. So Stephen Covey with 7 Habits of Highly Effective People, begin with the end in mind, right? Yeah. So where do you want to be? And then you reverse engineer it. And then we start to build out the plan and figure out, okay, so now we know where you want to be. And now we need to figure out where you are and then create that bridge and see what the structure and strategy needs to be and start to, go step number 1, step number 2, step number 3.
That's not a finance joke, is it?
No. Yeah.
Amazing. Well, this has been very enlightening, and I'm sure people are going to have a lot more questions and ultimately get a hold of your analyzer. Yeah. What's the best way for our listeners to reach out and get a hold of you?
Yeah. You can visit our website. That's www.greenmortgageteam.ca. Also email us at info@greenmortgageteam.ca or call us 604-229-5515, and we're happy to do that. The other thing that is very cool, kind of touch on really quickly here, because this is very relevant for investor clients too, it's a real pain in the butt to get a mortgage, right? Yes. It really is. And if you have 5 properties, it's an even bigger pain in the butt. So in-house, we've been creating some software, and we're at a point now where we can start beta testing it and using it, and it's very effective. But it allows us to have somebody fill in a worksheet with their current portfolio and fill in their income, et cetera, and without pulling their credit and without getting any documents. Usually recommend at least the tax returns if you have a bunch of rental properties, but technically without any documents, we can actually analyze your portfolio, run the analysis with 32 lenders, and see what your options look like before we even ask for the documents. Because it saves us and our borrowers a lot of time. Instead of saying, yes, let me see what I can do for you. Here's the 500 pages of documents I need, and then I'll let you know if it's doable.
Yeah.
Instead, we say fill in a spreadsheet to the best of your ability, send it back. We'll run it through our software, tell you what we think the options would be based on your inputs, and then we decide if it makes sense to collect the documents and go through the process. So it's just a nice little dip your toes in the water before you jump in head first and realize you've wasted a lot of time.
Yeah. No one will lend to me.
Yeah, exactly, right?
Not just a mortgage broker, but a tech mogul in the making.
Yeah, exactly. Yeah.
Is that your AI platform?
Yeah, exactly, right? Soon to be.
Brilliant. Well, Kyle, thank you again so much. This has been amazing. Really happy to have you on, and hopefully we can get you some great brand new clients from this.
Absolutely. Yeah.
All right.
Thanks a lot.
Thanks, everyone, as always, for tuning in. We will see you again next week.